The Treasury has just made a move that could look bullish for markets on the surface, but underneath it, there is a much bigger question developing for the dollar, US debt, and ultimately gold and silver. The US Treasury announced that it would at least double the size of certain buyback operations for longer-dated Treasury securities, increasing them from $2 billion to at least $4 billion per operation. The move is scheduled to begin September 9th and focuses on longer maturity debt. And the immediate market reaction was exactly what you would expect if you were watching the bond market in real time. Long-term Treasury yields moved lower, the dollar weakened, and gold pushed sharply higher. Reuters reported that the 30-year Treasury yield fell almost 10 basis points immediately after the announcement, while the dollar index also declined. But here's where I think investors need to slow down. Because this is not simply a story about Treasury buying bonds and markets celebrating lower interest rates. The bigger question is, why does the Treasury feel the need to become more aggressive in managing the long end of the bond market in the first place? I'm Alex James, an independent economic gold and silver analyst, and this is Macro Bullion. And today, we're looking beyond the headline. Because when you connect the Treasury buybacks with long-term yields, the dollar, gold, and silver, you start to see a much bigger macroeconomic story developing. The source material behind today's analysis captures the immediate reaction very clearly. Yields were falling, the dollar was falling, and gold and silver were moving higher. And the latest market data confirms that relationship. Standard Chartered reported that the 30-year Treasury yield fell toward 5.19% after the announcement, while the 10-year yield moved toward 4.65% and the dollar index dropped to around 98.9. That matters because gold does not pay a coupon. When bond yields decline, particularly real yields, the opportunity cost of holding gold can become less restrictive. And when the dollar also weakens, gold can receive another boost because it is priced internationally in dollars. That is exactly what we saw. Gold rallied strongly after the Treasury announcement, while silver also caught a bid. The World Gold Council noted that the Treasury's increased buybacks were followed by falling yields, a weaker dollar, and a roughly 3% jump in gold. But I don't want to stop at the first reaction, because there is a second side to this story. Treasury buybacks are not the same thing as Federal Reserve quantitative easing. Standard Chartered specifically describes this as a Treasury liquidity management operation rather than Fed-led QE. The Treasury is essentially reshaping the maturity profile of its debt, including buying certain longer-dated securities while relying more heavily on shorter-term issuance. And that distinction is extremely important because the bullish interpretation is straightforward. Long-term yields come down, financial conditions become less restrictive, stocks get support, gold benefits from lower yields, and liquidity-sensitive assets such as Bitcoin can also respond positively. But the bearish interpretation is much more uncomfortable. If investors believe policymakers are increasingly unwilling to allow long-term borrowing costs to rise naturally as fiscal pressures increase, then the market can begin asking a different question. If the bond market cannot fully absorb the fiscal pressure through higher yields, where does that pressure go instead? And that is where the dollar enters the story. Reuters reported that investors were concerned the Treasury's efforts to hold down long-term yields could shift some of the adjustment onto the US currency. The dollar subsequently fell to a 3-month low against the euro, while analysts questioned whether suppressing yields could ultimately undermine confidence in the currency. And for gold investors, that is the part of this story I would be watching most closely. Because gold isn't only reacting to today's yield move, it is increasingly becoming a market expression of concerns about debt, currency purchasing power, fiscal policy, and confidence in the long-term monetary system. And if those concerns continue to build, the Treasury's latest move could be much more important for gold and silver than the initial headline suggests. The first reaction to the Treasury announcement was powerful, but now we need to look at what happens when the market stops reacting to the headline and starts looking at the underlying numbers. The key point is that Treasury buybacks can influence liquidity and the composition of government debt, but they do not eliminate the fiscal pressures that pushed long-term yields higher in the first place. Standard Chartered describes the operation as a Treasury liquidity management tool rather than Federal Reserve quantitative easing, and notes that the buybacks remain relatively small compared with the roughly $30 trillion market for marketable treasuries. That distinction is critical for anyone watching gold and silver, because the initial reaction was almost textbook. Long-term yields dropped, the dollar weakened, and precious metals surged. On August 19th, Reuters reported that the 30-year Treasury yield fell by as much as 10 basis points. The dollar index dropped about 0.84%, and gold jumped more than 4%, reaching roughly $4,508 an ounce. But markets don't move forever simply because of one announcement. The question now becomes, can the Treasury actually change the long-term trend in yields? That's a much harder challenge. Remember, the 30-year Treasury yield had recently reached around 5.34%, its highest level since 2007. At the same time, U.S. public debt crossed the $40 trillion threshold, so the market is dealing with a structural problem. There is a huge amount of government debt that has to be financed, and investors have to decide what compensation they require to hold that debt for decades. Treasury can buy some of those securities. It can change the maturity mix. It can issue more short-term debt and buy longer-term securities. But unless the underlying fiscal trajectory changes, the pressure doesn't simply disappear. It can move. And that is where the dollar becomes extremely important. If investors begin to believe that policymakers are increasingly focused on keeping long-term borrowing costs contained while fiscal deficits remain large, the adjustment could increasingly show up through the currency instead. We've already seen a version of that reaction. The dollar weakened sharply following the announcement, while gold and silver moved higher. And this is where I think the gold story becomes more interesting than the simple headline of lower yields equal higher gold. Gold has now demonstrated that it can remain strong even while long-term Treasury yields remain relatively elevated. Bloomberg reported market commentary noted that gold's resilience suggests the rally is increasingly connected to concerns around dollar weakness and U.S. fiscal or monetary credibility, not simply falling yields. That is a major distinction. If gold were rising only because yields were falling, then a rebound in Treasury yields should create much more pressure on the metal. But if gold is also responding to concerns about the dollar and government finances, then the relationship becomes more complicated. You could potentially have a situation where yields rise because investors demand more compensation for holding long-term U.S. debt, while the dollar simultaneously weakens because investors become concerned about the fiscal outlook. And that combination could be very different for gold. This is also why silver deserves attention. Silver initially moved less dramatically than gold in the source transcript, but it still caught a strong bid as the dollar weakened and Treasury yields fell. More recent market data showed silver trading around $68.98 an ounce on August 21st, while gold was around $4,564. Silver has another advantage in this environment. It is not purely a monetary metal. It also has substantial industrial demand. So if easier financial conditions support economic activity and investment, silver can potentially benefit from that side of the equation as well. But there is an important warning. We should not automatically assume that every Treasury intervention is bullish forever. Standard Chartered explicitly describes the expanded buyback as relatively small in relation to the overall Treasury market and says the initial reaction may not represent a major structural change. And JP Morgan strategists have gone even further, warning that aggressive buybacks could potentially push long-term yields higher if investors interpret the policy as addressing the symptoms rather than the underlying fiscal problem. That is the contradiction sitting underneath this entire story. The Treasury wants lower long-term borrowing costs, but the market ultimately decides what yield it requires. If investors become more concerned about inflation, debt supply, fiscal deficits, or the credibility of policy, they can demand higher term premiums. And if that happens, Treasury may have to do even more. That's where the source transcript's more levers argument becomes relevant. The immediate market response can absolutely be positive, stocks rise, yields fall, and gold gets a boost. But the long-term question is whether intervention can overcome the fundamental forces behind the bond market. And that takes us directly to the next piece of the puzzle, the dollar. Because if the Treasury succeeds in keeping long-term yields lower, but the cost is a weaker dollar, then gold and silver may be telling us something very important about where investors are choosing to protect purchasing power. And that is where this story gets much bigger than a simple bond market announcement. The next piece of this story is the dollar, because the bond market reaction by itself does not tell us where this trend is going. The more important question is what happens if investors begin to connect Treasury intervention, rising federal debt, and the purchasing power of the U.S. currency. And right now, that connection is becoming harder for markets to ignore. The immediate reaction was clear. After Treasury announced that it would at least double the size of some longer-term bond buybacks, the dollar weakened while gold and silver jumped. Reuters reported the dollar index falling about 0.8% on the announcement, while gold surged more than 3%. That combination is extremely important for bullion investors, because when the dollar weakens, commodities priced in dollars generally receive a mechanical boost. But there is another layer. A weaker currency can also increase investor demand for assets that are perceived as stores of value outside the fiat system. And that is where gold enters the conversation. The source material makes the same connection. Markets initially welcomed lower yields, but the dollar reaction created a deeper currency story, with gold, silver, and Bitcoin all moving higher. Now, I want to be precise here. We should not call Treasury buybacks money printing or automatically label them as quantitative easing. They are debt management operations, not Federal Reserve QE. The World Gold Council makes that distinction very clearly, but markets don't have to wait for an official QE program to start thinking about currency risk. The U.S. national debt has now crossed the $40 trillion mark, adding another major backdrop to this discussion. And at the same time, long-term Treasury yields have been under pressure because investors are demanding compensation for holding longer-duration government debt. That creates a difficult balancing act. The government wants to finance itself at reasonable rates. Investors want sufficient yield to compensate for inflation, fiscal risk, and duration risk. And the Federal Reserve has to balance inflation against economic conditions. Those objectives do not always point in the same directions. So when Treasury steps in with larger buybacks, the market naturally asks whether this is simply improving liquidity or whether policymakers are becoming increasingly uncomfortable with where long-term yields are heading. And here's the fascinating part. The initial decline in yields did not last indefinitely. By Friday, the 10-year Treasury yield had moved back above its pre-announcement level, according to market reporting. That is something I would pay very close attention to, because if Treasury announces larger buybacks and the bond market initially rallies, but yields then begin climbing again, it tells us that the underlying supply and demand forces have not disappeared. The market is effectively saying, we hear the intervention, but we still want compensation. And if that continues, policymakers may eventually face an uncomfortable choice. Do they allow long-term yields to rise? Do they increase their intervention? Do they rely more heavily on shorter-term borrowing? Or does some of the adjustment eventually appear through the dollar? There is no simple answer. But gold and silver don't need to wait for that answer. They can move based on expectations. And that is exactly what we've seen this week. Gold climbed above $4,500 after the Treasury announcement, while silver moved above $66. By the end of the week, gold was around $4,608 and silver around $68.81 in one market update. So the precious metals market is effectively telling us that this is not just another bond market headline. Investors are watching the relationship between debt, yields, the dollar, and real assets. And there is another reason I think silver deserves special attention. Gold is primarily a monetary and reserve asset. Silver has that monetary component, but it also has industrial demand. So if the broader market environment remains supportive of commodities and economic activity, silver can potentially benefit from more than one direction. That's why silver can sometimes move much faster than gold once momentum gets established. But we also have to respect the risk. A strong move does not mean the market moves vertically forever. If Treasury yields rebound substantially, if the dollar stabilizes, or if expectations for monetary easing change, gold and silver could experience sharp pullbacks. So I don't think the correct conclusion is simply, Treasury buys bonds, therefore gold goes straight higher. The better conclusion is this: Treasury has revealed how sensitive the market has become to long-term borrowing costs. And when the market sees policymakers trying to influence those conditions while U.S. debt is above $40 trillion, investors naturally start thinking about what that means for the long-term value of the dollar. That is why I believe the dollar chart may become just as important as the gold chart from here. Because if the dollar continues weakening while long-term yields remain elevated, that is a very different environment from a normal rate cut cycle. And if that happens alongside continued central bank demand for gold and strong investor interest in precious metals, the next phase of this gold and silver story could become much larger than the initial Treasury announcement. The real question now is whether this is simply a powerful short-term reaction or the beginning of a broader shift in how markets price U.S. debt, the dollar, and hard assets. And that brings us to the final piece. What happens next for gold, silver, yields, and the dollar, and where the biggest risks are hiding? Now we come to the question that matters most. What happens next? Because the Treasury buyback announcement created an immediate shockwave across bonds, the dollar, gold, and silver, but the next move will depend on whether this is simply a temporary liquidity operation or the beginning of a much larger policy response. The first thing I would watch is the long end of the Treasury curve. The initial reaction was dramatic. The 30-year yield dropped roughly 9 to 10 basis points, the 10-year moved toward 4.65%, and the dollar weakened sharply. Gold simultaneously pushed above $4,500. But remember, the Treasury operation itself is relatively small compared with the overall Treasury market. Standard Chartered estimates that the Treasury market is roughly $30 trillion, meaning the increased $4 billion per operation buyback is significant as a signal, but not large enough by itself to solve the structural fiscal problem. And that gives us our first scenario. If long-term yields remain contained and the dollar continues weakening, that combination would remain supportive for gold. Gold has already demonstrated remarkable strength, even during periods when long-term yields were elevated, suggesting that investors are increasingly focused not only on interest rates, but also on currency purchasing power and U.S. fiscal concerns. Silver could potentially benefit even more if the risk-on environment continues. The metal surged roughly 5% to 6% following the buyback announcement, outperforming gold during the initial reaction. But there is a second scenario. What if Treasury intervention fails to keep long-term yields down? That's the scenario I would take very seriously. If investors continue demanding higher compensation for holding long-duration U.S. debt, yields could rise again, despite the buybacks. J.P. Morgan strategists have warned that without meaningful fiscal consolidation, interventions aimed at lowering long-term borrowing costs could actually fail to solve the underlying problem and potentially push term premiums higher. And we have already seen evidence that the first reaction doesn't necessarily last. After the initial Treasury-driven rally, longer-term yields came under renewed pressure as investors continued to focus on fiscal and inflation risks. So for me, the most important chart isn't simply gold, it's the relationship between gold, the dollar, and the 30-year Treasury yield. If the 30-year yield rises while the dollar strengthens, gold could face pressure. If yields fall and the dollar weakens, gold has a much cleaner bullish setup. But the most interesting and potentially most powerful scenario would be something different. Long-term yields remain elevated, but the dollar continues to weaken while gold continues making new highs. That would suggest the market is no longer treating gold simply as a trade on interest rates. It would mean investors are increasingly treating gold as protection against currency and fiscal risk, and that is already beginning to appear in the data. Gold broke above $4,600 this week, while concerns about U.S. debt sustainability and dollar weakness remained major drivers of the rally. For silver, I would watch whether the metal can hold the gains rather than simply focusing on the size of the initial spike. A sharp move can attract momentum, but the real test is whether buyers continue supporting the market after the first wave of excitement fades. And there is one more point I want to emphasize. The Treasury buyback should not automatically be described as the Federal Reserve printing money. It is a Treasury debt management operation, and it is different from Fed quantitative easing. But that doesn't make the development irrelevant. The important signal is that policymakers are paying increasingly close attention to the long end of the Treasury curve at a time when U.S. public debt has crossed $40 trillion and long-term borrowing costs have reached levels not seen in many years. And this is why I believe the bigger story isn't today's gold candle. The bigger story is the policy dilemma developing underneath it. The government wants lower borrowing costs. Bond investors want adequate compensation for risk. The Federal Reserve wants to manage inflation and financial conditions. And the dollar has to absorb whatever adjustment the market ultimately demands. If those objectives continue pulling in different directions, gold and silver could remain central beneficiaries of the uncertainty. So my base case is simple. Don't chase the headline, watch the confirmation, watch the 30-year yield, watch the dollar, watch whether gold can maintain its breakout, and watch whether silver can hold its gains after the initial Treasury-driven surge. If the dollar keeps weakening while gold remains above its breakout zone, the market could be telling us that this rally is becoming a much broader currency and fiscal story. And if silver continues outperforming gold, that could signal that the market is moving from simple defensive positioning toward a broader precious metals bull cycle. But there is still risk. Treasury buybacks are not a guaranteed solution, and a renewed bond sell-off, stronger dollar, changing inflation expectations, or tighter financial conditions could produce sharp pullbacks in both metals. So don't confuse a bullish macro thesis with a straight-line price forecast. The next few weeks should tell us whether this Treasury announcement was simply a temporary market shock or an early warning of a much bigger transformation in the relationship between U.S. debt, the dollar, and hard assets. For Macro Bullion, I'm Alex James, an independent economic gold and silver analyst. And as always, this analysis is for education and information only, not financial advice. Do your own research, verify the latest market data, understand the risks, and never make an investment decision based solely on a single market narrative. Because the real question isn't whether Treasury can move the market for a day. The real question is whether the market is beginning to lose confidence in the old rules and whether gold and silver are already pricing that change.